COMEX registered silver inventory just dropped below 100 million ounces, while March contract open interest represents over 425 million ounces of paper claims. If just 25% of holders demand their metal, the math breaks. We're 2 weeks away from finding out what happens when the music stops. Saturday, February 14th, 2026, New York time. Please share in the comments what day and date you're watching this from. I genuinely appreciate seeing how far this message reaches. Before we begin, a quick note. I'm currently working to reduce copycat channels that mirror this content. If you find value in what I'm building here, the best way to support this effort is simply by subscribing and leaving the name George Williams in the comments. It may seem small, but it truly makes a meaningful difference. So let's talk about what's actually happening at COMEX right now, because the numbers are getting uncomfortable for anyone paying attention. As of February 13th, 2026, registered silver inventory sits at somewhere between 98 and 103 million ounces, depending on which warehouse report you're looking at. Some analysts who dig deeper into what's truly deliverable claim the real number might be as low as 28 to 30 million ounces of metal that can actually move without legal complications. But let's give COMEX the benefit of the doubt and work with the reported 100 million figure. Now here's where it gets interesting. Total COMEX inventory is actually much larger, sitting at around 403 to 440 million ounces. But the vast majority of that is classified as eligible, not registered. And this distinction matters more than anything else you'll hear in this video. Eligible silver is metal that's stored in COMEX-approved vaults and meets all the quality standards for delivery. But here's the catch. The owner of that eligible silver hasn't made it available for delivery against futures contracts. Think of it like a parking garage. Eligible cars are parked there, but they're not for sale. Registered cars are the ones with "for sale" signs in the window. Only registered inventory can actually fulfill delivery obligations when someone with a futures contract says, "I want my silver." The media loves to report total inventory numbers because 400 million ounces sounds reassuring. But if you own a futures contract and want to take delivery, you can't just point at eligible silver and demand it. The owner of that eligible metal might be a silver ETF, a bank that's using it as collateral for something else, or a private holder who's just using COMEX vaults for storage. That metal might not be for sale at any price. So when we're talking about whether COMEX can fulfill delivery obligations, only registered inventory matters. And registered inventory has crashed 80% from its February 2021 peak of 152 million ounces. This is the lowest coverage ratio in COMEX history. January 2026 was supposed to be a quiet month. January is never a major delivery month for silver futures. It's one of those sleepy contract months where maybe 5 to 7 million ounces change hands, and everyone rolls their positions forward to March. Except that's not what happened this year. January saw somewhere between 33 and 49 million ounces demanded for physical delivery, depending on which source you trust. That's 7 to 10 times higher than historical January averages. In just 1 week in mid-January, 33.45 million ounces were withdrawn from COMEX. That single week represented 26% of the entire registered inventory vanishing in days. But here's what makes this even more significant. Traders were rolling their contracts forward to take delivery in January rather than waiting for March. Think about what that behavior tells you. If you're a trader and you want physical silver, March is the most liquid contract with the best pricing and the most open interest. There's no rational reason to take delivery in January unless you're worried that March might be worse. This is front-running behavior. Market participants are acting like they expect deteriorating conditions ahead, so they're grabbing what they can now while they still can. And February isn't even over yet, but deliveries have already hit 13.8 million ounces and counting. March is the major delivery month for silver. It's the most active contract of the entire year. Current open interest for March 2026 sits at somewhere between 85,000 and 91,000 contracts. Each contract represents 5,000 ounces. Do that math, and you're looking at 425 to 528 million ounces of paper claims on silver. Now, historically, only a small fraction of open interest actually stands for delivery. Most traders close out positions or roll them forward. The system works because everyone plays along and accepts paper settlements. But what if they don't? What if industrial users who actually need the metal start demanding physical delivery? If 20% of contract holders stand for delivery, that's 85 to 106 million ounces needed. That basically wipes out the entire registered inventory. If 25% stand for delivery, you need 106 to 132 million ounces. The math simply doesn't work. If 30 to 40% demand delivery in a stressed market scenario, You're talking about 127 to 211 million ounces needed, with only 100 million available. And remember, December 2025 already saw 46.635 million ounces delivered, which represented 50% of the free float registered inventory at that time. The buffer is gone. We're now in a situation where every ounce of deliverable silver backs more than 20 ounces of paper promises. This is fractional reserve banking applied to commodities. And just like fractional reserve banking, it works perfectly until people lose confidence and want their deposits back. The exchange for physical spread, which measures the premium that physical metal commands over futures contracts, has widened to $1.10 per ounce. Normal EFP spreads run 10 to 30 cents. When you see it at $1.10, that's telling you there's desperate demand for physical metal. The market has also exhibited backwardation repeatedly, which means spot prices are higher than future prices. That's abnormal. In a normal commodity market, futures trade at a premium to spot because of storage and financing costs. Backwardation signals that people want metal now, immediately, and they're willing to pay more for it than for promises of metal later. The stress isn't just at COMEX either. London lease rates tell the same story. In October 2025, London silver lease rates spiked to 34.9%. Intraday peaks hit 39.2%, according to the Japan Bullion Market Association. Normal lease rates are below 1%. Anything above 5% indicates serious stress. By late October, rates had declined to 5.6%, but they remain elevated compared to historical norms. What this means is that industrial users who need to borrow silver for manufacturing are paying huge premiums. When a jewelry manufacturer or a solar panel company needs silver, and they have to pay 35% annualized interest just to borrow it for a few months, that tells you physical metal is tight. And then there's what I call the corporate bypass strategy, which might be the most telling signal of all. Samsung C&T finalized a mining prepayment deal in late 2025 where they provided $7 million to Silverstorm Mining to restart the La Paria mine in Mexico. The key clause in that contract gives Samsung the exclusive right to purchase 100% of that mine's silver concentrate output for the next 2 years. Samsung isn't buying paper silver on COMEX. They're locking up mine supply directly at the source. Tesla and other tech companies are reportedly doing similar deals with miners. This is vertical integration and resource lockup. These are sophisticated corporations with expert commodity teams. If they trusted COMEX to deliver metal when they need it, why would they bother with these complicated direct mining deals? The fact that they're bypassing exchanges entirely tells you everything about their confidence in the system. Now, before we get too deep into doomsday scenarios, let's talk about the counter-arguments because they matter. When delivery occurs at COMEX, physical silver often doesn't actually move from the vault. What changes hands is a warehouse receipt, a warrant that represents ownership. The same physical bars can satisfy multiple deliveries through warrant transfers. A single bar of silver might change ownership 5 times in a month without ever leaving the vault. This is why you can sometimes see more deliveries than the decline in registered inventory would suggest. The metal doesn't have to drain completely for the system to function. So delivery doesn't automatically mean drain in every case. COMEX also has extensive emergency powers that they can invoke during market stress. They can implement position limits, forced liquidation, extended delivery periods, or forced cash settlement instead of physical delivery. They can adjust contract specifications claiming force majeure conditions. There's historical precedent for this. The LME suspended nickel trading and actually canceled trades in 2022 when prices spiked. The Hunt Brothers silver crisis in 1980 led to rule changes that crushed the market mid-squeeze. Exchanges exist to protect themselves and their member banks. They're not going to allow an orderly default that destroys the institution. They'll change the rules first. However, if they force cash settlement at artificially low prices, while physical metal is trading at massive premiums, that would destroy COMEX's credibility as a price discovery mechanism forever. There's also been some misleading analysis floating around. Some analysts claimed February saw a 98% delivery rate, suggesting panic. That figure was based on a calculation error where they divided total deliveries by a single-day open interest snapshot. But open interest is dynamic and constantly changing throughout the month. You can't use that methodology to calculate a meaningful delivery rate. Plus, February is a minor delivery month with low participation. You absolutely cannot project February's behavior onto March. March includes hedge funds, banks, commercial users, industrial buyers, all with completely different intentions and strategies. The supply-side constraints make this whole situation more interesting. 70% of silver comes as a byproduct of copper, lead, and zinc mining. You can't just decide to produce more silver because prices are high. If the copper mine isn't expanding, the silver production from that mine isn't expanding either. Mine development takes 7 to 10 years from discovery to production. Declining ore grades mean it takes more energy and cost to extract the same amount of silver. Mine production has been essentially flat at 830 million ounces annually for years. Meanwhile, industrial demand sits at 650 million ounces annually and growing. Solar panels, electric vehicles, AI data centers. The structural deficit for 2026 is projected at 67 to 200 million ounces, depending on assumptions. This is the 6th consecutive year of deficits. So what actually happens next? I'm going to lay out 3 scenarios with honest probability assessments, and I want to be clear that I don't know which one will materialize. Anyone claiming certainty about March is either lying to you or delusional. The orderly resolution scenario, which I'd put at about 35% probability, goes like this. March delivery demand stays below 20% of open interest as most traders behave normally and roll positions forward or accept cash settlement. COMEX manages to fulfill deliveries through a combination of registered inventory, some eligible conversions, and possible warehouse inflows from producers. Some owners of eligible silver see an opportunity to earn delivery premiums and convert their metal to registered status. Banks and large institutional traders accept cash settlement rather than demanding physical because they're just hedging price exposure anyway. The exchange uses its full toolkit: extended delivery windows, incentives for cash settlement, maybe adjust some contract specifications at the margins. Silver trades in the $75 to $95 range through March, with elevated volatility but no crisis. The market views this as proof that COMEX's system works. Price slowly grinds higher on fundamental supply-demand through the rest of 2026, reaching $100 to $120 by year-end. Physical premiums remain elevated but manageable. Life goes on. The stressed but no default scenario, which I'd put at 40% probability, looks different. March delivery demand reaches 25 to 35% of open interest, higher than normal but not catastrophic. COMEX experiences real strain, but the system doesn't break. Registered inventory gets drawn down to 40 to 60 million ounces during the peak delivery period. Some eligible converts to registered, but not enough to prevent stress. The exchange implements aggressive measures. They raise margins significantly, extend delivery periods, offer cash settlement incentives, possibly temporarily limit position sizes. Some participants get forced into cash settlement who actually wanted physical metal. This creates anger and loss of confidence but avoids technical default. Silver spikes to $110 to $140 during peak stress in late March as the physical premium explodes. After the delivery period ends, price settles back to $90 to $110 range. But there's long-term damage to COMEX's credibility. More industrial users pursue direct mining deals like Samsung's. A two-tier market starts to emerge where physical metal trades at significant premiums over paper, and paper contracts become increasingly distrusted. This accelerates the decoupling trend that's already underway. The market fragments completely. COMEX futures become meaningless for price discovery. Real pricing starts happening in physical-only markets in Shanghai, India, the Middle East. Major producers and consumers abandon COMEX entirely. Within 6 to 12 months, silver establishes new price discovery mechanisms outside traditional exchanges. Depending on physical supply and demand dynamics, silver could stabilize anywhere from $120 to $250, with huge regional price variations and no single authoritative price. For long-term investors, this could be the event that finally breaks the paper-physical link that silver investors have been predicting for literally decades. If you believe in the supply deficit thesis, weakness in paper markets might create last opportunities to accumulate physical at prices divorced from physical market reality. But also recognize that exchanges might change rules in ways that hurt everyone, even physical holders, through regulatory intervention or taxation. For mining stock investors, if COMEX credibility collapses, producers gain massive leverage because they control the actual physical metal that everyone suddenly wants. Streaming deals and direct sales could command huge premiums. But watch for government intervention, because if silver becomes viewed as strategically critical, regulatory risk increases dramatically. Nobody knows what will happen in March with certainty. The math suggests strain. The behavior suggests stress. The corporate actions suggest distrust. But exchanges have powerful tools to manage or suppress price discovery. The likeliest outcome probably isn't Hollywood drama with COMEX defaulting and silver shooting to $500 overnight. It's more likely a messy compromise. Some forced cash settlements that anger participants. Some fulfilled deliveries that drain inventory. Lots of anger, regulatory investigations, and a slow, grinding loss of faith in paper-silver markets. That's not as exciting as the doomsday scenario, but it's more realistic given how these systems protect themselves. And here's the uncomfortable truth that might actually be the most important takeaway from all of this. That grinding loss of faith might be more bullish long-term than a spectacular crisis, because it's harder for authorities to stop. A crisis they can manage with emergency powers and rule changes. But a slow, steady erosion of confidence as industrial users quietly bypass the system? That's much harder to contain. We're not waiting for COMEX to default, we're watching it become irrelevant. And that might be the real story of 2026.